Hello, everyone, and welcome to the third panel of today's event, How to Deploy Climate Finance. My name is Caitlin Crouch-Hess. I'm a director at RMI's Center for Climate-Aligned Finance, which is a nonprofit dedicated to helping unlock the critical trillions needed for real economy decarbonization, of course, in line with 1.5C. So it's an absolute pleasure to be a part of the second annual Economist Sustainability Week in the US. I have the honor of being joined by three distinguished panelists: Ifo Mulder, who is the head of Climate Finance Unit at the UN Environment Program; Ben Ratner, who is Executive Director of Sustainability at JP Morgan. We have with us today Misha Schildman, Vice President of Strategy at Planetly, which is now part of OneTrust. So the panelists today offer three complementary perspectives on climate finance. We have Ivo, of course, from an organization that sets the science-based direction for where we all have to go. We've got Ben from an institution that deploys capital, and Misha from a company that measures how effectively companies are decarbonizing. So in the next few minutes, we'll focus on three topics in particular: crowding in finance through policy support, getting money out of the door, and measuring efficacy. So let's jump right in with our panelists. I'm going to start off with you, Ivo. We've both and all, I think, been in this field long enough to know that conversations about climate finance usually start with the private sector needs policy support. So could you talk a little bit about how governments have effectively crowded in financing for things like renewable and energy efficiency? Are there any specific countries or states that you'd like to highlight?
Yeah, thanks, Caitlin, and thanks for the organizers for having me. I mean, there's obviously a whole range of economic and regulatory measures that can be deployed by governments to crowd in private finance. I think a well-known example is feed-in tariffs. The Energiewende in Germany, or the energy transition, providing feed-in tariffs, price certainty enables investors to calculate revenues in a more stable and predictable way. Other economic incentives, such as subsidies, tax breaks, and investments in research and development, are very important. But also the flip side is important: is to make polluters pay for the negative impact they're having on climate change, for example, through carbon taxes or effective cap and trade systems. In terms of countries and states that have been effective, I think what is often overlooked and perhaps not well known to everyone is that on an annual basis, investments in developing countries actually outpace investments in developed countries. And a few notable examples are, for example, a very large solar investments in Dubai, large-scale offshore wind investments in Taiwan, but also Chile, for example, are interesting examples. But on a year-to-year basis, investments in China are the largest in terms of renewable energy investments. So those are some examples. But even though the US and Europe make up, I think, a big share, I think we shouldn't underestimate investments happening in developing countries.
Excellent, thank you. Ben, over to you. Speaking of policy support, what are some of the effective policy solutions you've seen or even would like to see that can really enable capital flows into low carbon initiatives?
Thanks, Caitlin. It's great to be with you in the panel today. Well, we agree climate change is such an important and a complex issue that it really requires business and government leaders rowing together. In fact, thoughtful policy really is one of the prerequisites for achieving our commonly shared goal of net zero emissions by 2050. It may take a moment to remember, working with the US example here, the success story of rapid deployment and adoption of renewable energy is due, at least in part, to a legacy of public policy solutions and enablers, things like state renewable portfolio standards and different forms of federal tax incentives. So coming to the present moment, a carbon tax that directs some of the proceeds to help offset energy costs for underserved communities is one of the policy opportunities that we see and would support. Also, thoughtful policies that spur investment in technology R&D that can have a catalytic effect in bringing technologies along that are investable and deployable at scale as they mature.
Excellent. Thank you for that. And Eva, back to you for just a moment. How do you feel that policymakers could better crowd in private finance for nature-based solutions in particular? And are there any specific cases you'd like to point out?
Yeah, so first to demystify this relatively new term, nature-based solutions. I think a lot of people are quite well aware what it means in terms of investing in offshore, onshore wind and solar. What is meant by nature-based solutions are investments in sustainable agriculture or forestry that do not lead to emissions, but actually take away emissions and protect biodiversity. You can think about green spaces in cities to reduce the effect of extreme heat, or green roofs. So, in terms of investments in nature-based solutions, a lot of scientists and economists have calculated that it actually can be done. 30% of the climate solution could be invested cost effectively in nature-based solutions. At the moment, only 3% of public climate funding is directed towards NBS. This is not to say that investments in sustainable transportation, renewable energy, and energy efficiency are not important. It's just that there is a tiny trickle of public money going towards changing the way how nature, forestry, and climate change are being invested in at present. And as a result of it, the share of private finance is extremely small. How to change that? I think the investment case will have to be strengthened, like in renewable energy, for example, through blended finance. So increasing the amount of private finance by lowering the cost and risk for private financiers through concessional finance by governments. Repurposing agricultural fiscal policies like reducing fossil fuel related subsidies. It is a very tricky issue, and obviously there's a lot of vested interest, but that's important. But also providing a stable price for forest carbon, for example. So those are some examples. In terms of where it is happening, I was recently visiting Brazil. There have been several interesting investments, for example, by private equity funds like Green Fund and Agri-Free Fund. Those are not household names, but those are funds that are trying to, through guarantees and through long-term patient capital, changing the way how soy, cattle, and palm oil, for example, being financed by decoupling the production of those commodities from tropical deforestation, or by prioritizing the use of degraded land over converting ecosystems. And those are kind of commodities that we use on a day-to-day basis. And they are, like renewable energy and energy efficiency, part of the solution that we need to strive for.
Excellent. Thank you, Ifo. Shifting gears a little bit, we've heard about how can policy be a lever for really crowding in finance and stimulating the flow of capital. Speaking of the flow of capital and really getting money out of the door, turning to you for another moment, Ben, the refrain that we've heard the last few years is that there's lots of money chasing too few deals or projects. We've discussed that policymakers can do a lot, but what's JP Morgan Chase's strategy for financing climate action? Perhaps you could say a little bit about that, and maybe also what, in general, large financial institutions can do to help generate bankable deals in a proactive manner.
Well, at JP Morgan Chase, we have a three-part strategy for financing climate action. Where that starts for us is helping green go big. So last year, we set out a $1 trillion target over 10 years for financing and facilitating green initiatives. That is part of a broader target of $2.5 trillion for sustainable economic development over that same time period. And just in recent weeks, through our ESG report, we shared that we financed and facilitated over $100 billion last year alone, propelled by significant activity in renewable energy, in energy efficiency, and in sustainable transportation. So there are some growth areas and real opportunities there. The second a part of our strategy on climate finance is really supporting industry transition. I think we're all following the energy security crisis and complications in energy markets that shines a spotlight on the need to help provide energy reliably, securely, affordably, meet today's needs, while also keeping the pedal to the metal on the low carbon transition. And a centerpiece of our work in supporting industry in transition was becoming the first of the large US banks to set carbon intensity reduction targets last year for sectors like oil and gas, electric power, and automotive manufacturing. And then the third and final part of our strategy on climate finance is to walk the walk in our own global operations. We have more than 6,000 facilities when you count branches and corporate offices and data centers. We met our carbon neutrality goal for the second year running, and we're pleased to recently announce that our new Manhattan headquarters, which will be 60 stories, will have zero operational emissions and be all electric. So that's the three-part approach that we're taking.
Excellent. Maybe just coming back to this question of, can commercial banks be proactive? Is there a way for financial institutions to help generate bankable deals? I know that often, in particular, commercial banks are kind of seen as the last step in the process, and everything needs to be kind of done and dusted before money can be accessed. Is there a way for global financial institutions to be more proactive, to try to generate more of these bankable deals?
Well, one of the steps that we took last year was to establish the Center for Carbon Transition, which sits within our corporate and investment bank and regularly engages with clients, corporate clients in a range of sectors to support their navigation of risks and also capturing of opportunities in the low carbon transition. So that's a proactive approach. We also established a new green economy team in our commercial bank that supports companies that are growing and seeking out proactive ways to take part and help to forge ahead in the low carbon transition.
Excellent. Thank you, Ben. And congratulations as well, of course, on meeting some of those massive sustainability goals. I've got one more for you, Ben, before we move on to Misha, as we sit here in the how to get money out the door, being a part of a global financial institution that does that exactly. Just want to talk a little bit about this mitigation versus adaptation and resiliency piece, with mitigation, of course, being about decarbonizing our energy system, for example, and adaptation and resiliency really being about helping people cope with the impacts of climate change. Is it really practical for private financial institutions to split out mitigation versus adaptation or resiliency? And maybe you could tell us a little bit about how your firm is approaching this.
Thanks, Caitlin. For starters, I think it needs to become mitigation plus resilience rather than mitigation versus resilience. There's been such emphasis, of course, on the mitigation side, rightfully so, our collective path to net zero emissions by 2050 and the roles of financiers, of investors, of corporates, and government. But resilience is an important issue as well. And for example, we're learning from experts, places like the Atlantic Council, that physical manifestations of a changing climate, like extreme heat, can cause annual economic loss in the US alone, lost worker productivity of $100 billion, while also contributing to mortalities and difficulty with students learning and higher crime. So our current approach to resilience includes philanthropic capital, grants through the JP Morgan Chase Foundation that are designed to partner with and lift up nonprofits and other colleagues in different parts of the US and the world and support communities in their ability to withstand equitably and successfully the effects of a changing climate. We are also exploring how more different types of capital can be put into resilience. And maybe lastly, it's worth pausing to recognize that some solutions are true win-wins. they double as both mitigation and resilience. So, for example, think about something like distributed renewable energy that offers some independence from the centralized electricity grid in the case of a reliability interruption, while also offering zero or low carbon forms of energy.
Absolutely. Thank you. Misha, over to you. I know that Planetly helps companies with their carbon reduction strategies, and clearly you're deeply involved in mitigation. Are your clients also approaching the topic of adaptation, and could you shine some light on that for us?
Great question, Kevin, and thanks for having me. So yeah, as you said, as most of our customers are companies from the software sector, consumer goods or manufacturing segment, they focus more on reduction strategies, which is also the focus of our work. But we do see a transition towards also adaptation driven by regulation frameworks such as TCFD, where adaptation is also part of a broader framework on adjusting to the new world. And we are also in the progress of adapting our offering accordingly. Currently, as our industry focus is not yet on larger financial institutions such as banks who have stronger or stricter requirements in that regard from also a risk management perspective. This is still a bit nascent on our side, but we do see growing market demand on this, and we definitely want to also provide our customers with solutions on that. An interesting side note, though, and going back a bit to the nature-based solutions that were discussed earlier, given that we also serve a lot of private market investors, such as PEs or VCs, who also look for alternative investment spaces, such as nature-based investments, we do see a lot of interest there, and also see the potential of private markets and players such as PEs, also as Ivo mentioned, in driving also the development of these solutions. But I think this is also, again, as Ivo said, dependent on regulatory frameworks, on regulation, on fixed carbon prices, as the current systems that are deployed, such as the voluntary offset market, is not mature and not stringent enough to give the security to investors. But I think that's also a topic for COP26, which we will discuss later.
Excellent. Thank you, Misha. I'm going to stay with you for this last section as we move on to the topic of measuring efficacy, and that is the bread and butter at Planetly. So I just wanted to ask a little bit about how you're seeing financiers measure the impact of their investments. Are there new trends you're seeing emerge from financial sector clients in addition to the ones you just mentioned? And what are your clients hearing from their capital providers? In essence, I do hope we're moving beyond just disclosures.
Yeah, that definitely resonates to move beyond just disclosures. And as said, our focus is on private market investors, so PEs, VCs, who usually have, especially the PEs, have a quite significant influence on their investments, so the portfolio companies and their activities. And we do see a lot of ambition and activity from these players, and also shaping the decarbonization activities of the portfolio companies very proactively, not only from a perspective of exactly as you referred, not only disclosure, but actually generating value and value for the investors, value for the company, through sustainable policies, through investing into more sustainable companies. And that in the end is mainly driven also by the limited partners, so investors in the PEs and VCs, who in the end are actually affected by mainly regulatory measures on the one hand side, so the upcoming EU taxonomy, SFDR, etc. But on the other hand, also have a long-term perspective on value generation. And I think that is an interesting development also from a macroeconomic perspective, that institutions realize that in the long term, only sustainable investment will generate stable returns. And I think this is what is changing the game. That is also what basically when I was starting at McKinsey building the climate change service line, that I think was where we really saw a change in the industry with huge banks, huge investors, either reinsurers or pension funds who really understood, who have a very long-term perspective, who really understood they need to make this shift as soon as possible to be able to serve the purpose, which is generate yield. And I'm really excited actually to see how this movement or this this direction will just accelerate in the coming years. This momentum will accelerate.
Yeah, absolutely. Likewise. On the topic of being effective and generating value and having a real impact, I just want to reflect on this particular word and the title of this panel, effective. So Ben and Ifo, I'll let you two, maybe starting with you, Ifo, reflect on the next question, which is how to think about efficacy and applying this in your climate finance work. And maybe you can also provide an example of the last effective action that you took and what you learned from it.
Yeah, thanks, Caitlin. I mean, I think from my perspective, I'm sure Ben and also Michelle would have an opinion about it. I mean, there's obviously a plethora of so-called ESG and sustainable funds, but I think what they don't provide is, as you probably also know, Caitlin, is the actual extent of emissions that are emanating from those investments that I would want to know as an individual investor, and that also institutional investors often have no knowledge of. In a similar way, though, many of those ESG and sustainable funds, we don't know the extent to which they are aligned with the 1.5 degree target. I think that is I think the next big hurdle for the asset management and asset owner community to tackle. But I think when you talk about efficiency is to agree on minimum standards to call something green or sustainable. And the EU, you now have something called the EU taxonomy on sustainable finance. I think the US is also interested in moving towards minimum carbon standards, basically, to make sure that not everything can be called green or sustainable or ESG. And in my view, what it would mean is to basically be aligned with the 1.5 degree target. Which means that a lot of investments that are currently rebranded ESG would probably fall by the wayside. What I think is also important, I think, for banks and investors, but again, be interested to get Ben's take on it, is to move beyond individual deals that could be quite expensive to structure, basically moving beyond over-the-counter transactions to standardized financial products, basically. And in the context of nature-based solutions, we're working, for example, with a Dutch bank, Rabobank, who's recently developed a standardized loan product to finance farmers in Brazil that are exclusively using degraded land for soy and cattle, for example. And those are slightly more complex transactions, but with the help of a guarantee fund, there's basically a standardized term sheet that helps loan officers reduce the transaction costs for those by having it basically pre-agreed with a guarantor.
Really interesting. Ben, what do you think? How can financiers be more effective in their climate action?
Well, as a bank, we tend to take a quantitative approach to efficacy, and targets, which I mentioned earlier, play an important role. As I mentioned, the Center for Carbon Transition helped to roll out carbon intensity reduction targets to 2030 for oil and gas, electric power, and automotive. And to your question of, what we learned, these targets can be valuable in creating shared expectations, providing some guardrails for financing activities, and really fostering two-way dialogue over time with clients and other stakeholders. I would also say, Caitlin, that we learned that as important as it is as a milestone out of the gate, to establish emission reduction targets, that's just a start. And there is active work underway to implement these targets. One thing that looks like in the pursuit of efficacy, your question, is assessing client emissions and decarbonization plans to feed into our decision making on new transactions to test for alignment with the direction of travel for Paris-aligned financing. And so there are tools that are now in use, both backward-looking and forward-looking, both quantitative and quantitative, to assess the alignment and to make sure that we're well positioned to support clients in the low carbon transition. And actually, we're using those both for lending and also for debt capital markets. The last thing that I might mention is on the financing target side, the $2.5 trillion over 10-year sustainable economic development target. We take a thoughtful and evidence-based approach on what is green, what falls on that side of the line, what really contributes to sustainable economic development through things like our development finance initiative and consulting the best practices in the market.
Excellent. Thank you so much, Ben, Ifo, Misha. We're rounding up the last few minutes of our panel here today, and I just want to absolutely thank each of you for your contributions. Just as the last question here, we're going to take 1 minute for each of you to answer this question, which is, for you, what is the one specific action that you want to see either announced or completed at COP27 this year? Let's start with you, Misha.
Wonderful, thanks. Yeah, for me, the most urgent question is, and I touched upon this earlier a little bit, is the price of carbon and the taxation of companies who create carbon. And to have a framework around this, will take time, but I think we need to have at least a clear roadmap towards a market instrument like this, because otherwise there will never be a way to hold polluters accountable. And I think that's the biggest priority for myself.
Thank you. Ifo, would you like to go next?
Yeah. So I think what's important is to take a step back and to say that despite the massive amounts of climate finance, for example, by JP Morgan, many other finance institutions and public development banks, as well as governments, is still nowhere near enough to meet the 1.5 degree target. If we are to meet the 1.5 degree target, investments in climate finance will have to increase by 590%. So basically a 6-fold increase from the current levels of 630 billion, which means that virtually every institution around the globe will have to be aligned with these 1.5 degree targets, which is nowhere near where we are right now. I think the second point is that the effects of climate change are already being felt everywhere in the world, from developed to developing countries. But especially in developing countries, the poorest communities are already being hit right now, and they're already being driven to despair. And the last point I'd like to make is a bit to Misha's point. I think we need a stable price for carbon, and especially in the field of nature-based solutions, we need a minimum price for forest carbon or for blue carbon in order to crowd in private finance.
Excellent, thank you, Ifo. Ben, last but not least, you.
Starting by agreeing with that last point, that the impacts of the changing climate, more frequent and severe weather events are falling hardest on the most vulnerable, which is a reason for that topic to receive more attention and more action in the years ahead. But actually, the topic I wanted to focus on is, if you think back, cast our minds back to COP26, reducing methane emissions was one of the focus areas and headlines, with dozens of countries making new pledges and commitments. Earlier this year, our chairman and CEO, Jamie Dimon, emphasized reducing methane emissions in the oil and gas sector and reducing natural gas flaring as immediate opportunities to cost effectively reduce emissions associated with fossil fuels today. So that's one of the areas where looking for continued progress as leading companies take action to monitor and mitigate and report on methane emissions.
Well, I just once again want to thank you all for your contributions today. This has been excellent content and so much for all of us to take back and think upon. So once again, thank you to all of the participants and joiners in today's panel.